And look, falling home prices just handed your bank something, and you didn't sign off on it. No letter, no phone call, no missed payment. But the day your home's value started sliding, a door opened, right on cue. One the bank couldn't walk through while prices were going up. That's the way in, and almost nobody who has it knows it's there. Behind it is your own equity, frozen. Not the house, they can't take that, just your access to the money you thought was yours. If you've been the responsible one, you saved up, you sat through open houses where the realtor called a damp basement vintage charm with aquatic potential, you finally bought the place, and you've made the payment every month and never borrowed against it like everybody warned you not to, here's the part that's gonna bug you. You are the most interesting person in the building to a nervous bank. Not the guy who's behind on everything. No, you, the clean record, the fat cushion. That's the collateral they like best. And if you've ever told yourself, well, at least I've got the equity in the house if things get tight, stay with me. Because that equity is not as much yours as you think, not the part you can actually reach. Let's start with what's actually happening to prices, because the headlines keep dancing around it. For 3 straight years, your house did nothing but go up. Equity stacked on equity. The average homeowner with a mortgage is sitting on about $295,000 of it right now. Historic highs. You feel rich. You're basically Scrooge McDuck if his vault was made of drywall and 2x4s. That's the headline. That's the part they want you to hear. Here's the part they say quietly. Late last year, for the first time in a very long time, that pile stopped growing. And a lot of the country, it started shrinking. Prices are falling outright in 39 of the 129 biggest cities in America. Cape Coral, Florida, down 9% in a single quarter. Austin, off almost 28% from its peak. And that same cheerful report bragging about your historic equity, buried a few pages in, 372,000 homes drop underwater on just a 5% dip. Loan-to-value ratios climbing everywhere. More and more people are owing 85, 90% of what their house is even worth. A few percent. Doesn't sound like an emergency, right? Well, here's why it is. Picture your equity as a ladder leaning up against your house, and the bank is the one holding the bottom of it. While prices climb, they hold it steady. Climb as high as you want. Take the line of credit, tap the equity, they're right there, bracing it for you. The day prices dip, they don't take the ladder away, they just let go of the bottom, right when your foot's on the top rung. Same ladder, same house, the only thing that changed is whether they're willing to steady it. And that letting go, it has a name in your paperwork. And real quick, before I show you, let me kill one piece of jargon so I don't lose you. I'm going to keep saying liquidity. All that word means is cash you can actually get your hands on in a day or two. Not money locked up in your house, money in hand. This whole thing turns on the difference. Here's how it actually works, and it's more boring than a documentary on the history of the paperclip, which is exactly what makes it real. Your bank doesn't knock on your door. It watches one thing, the gap between what you owe and what your house is worth. That gap is your cushion. When prices were climbing, the cushion got fatter every month, and a fat cushion is a bank that leaves you alone. When prices fall, the cushion gets thin, and you didn't borrow a dime to do it. Your house just lost value, so the gap shrank on its own. Thin cushion, nervous bank. The bankers track it with a number, loan to value, but that's all it measures, how much cushion you got left. And buried in the rules, Regulation Z, the same rule book that's supposed to protect you, there's a line that says if your value drops far enough, the bank can freeze your home equity line, cut it, suspend it, even if you've never missed a single payment. And the letter that tells you they did it, it shows up 3 business days after they've already done it. And this is important, even if you don't have an equity line, and I'll tell you why in a second. But if all this sounds like some worst case what if, it already happened, and it had a name on it. The last time home prices slid like this, Chase froze and cut so many of these lines, blaming a drop in your home's value, that homeowners dragged them into court. The lawsuit said Chase was freezing people whose homes hadn't actually lost a dime. Chase denied it, then settled anyway. And Chase wasn't even alone in this. That same stretch, Countrywide suspended around 122,000 lines. The playbook isn't new. It's just been sitting in the drawer, waiting for prices to turn. Now, one thing they can't do, so you don't lose sleep over the wrong thing, they can't call your actual mortgage. You're paying on time, the house is yours. They can't touch it for that. This isn't foreclosure. It's quieter. It's your access they can take. The umbrella, not the house. You know, I check regularly on the banks to assess their desperation level. And turns out right now, they're doing great. Record profits last quarter. Those losses everybody panicked about 2 years back, down 21%. The problem bank list is totally, boringly normal. But here's the part most don't realize. They don't have to be in trouble to do this. Anticipating trouble can be enough. And that's a little colder when you think about it. The tool works the same whether they're scared or swimming in money. Your value drops, the option opens, and a perfectly healthy bank uses it in a perfectly routine way. Now here's the part I can't prove, but here's what I think is actually happening. There won't be a headline. There won't be some big freeze wave. It'll go one letter at a time. Cape Coral, then Austin, then the next town that softens. And the rest of the country won't hear a word about it until it's their turn. Now, you may be thinking, well, I don't have an equity line on my house, not my concern. But if defending your home is important to you, it very much should be your concern. And here's why. I got a buddy. He flips houses for a living. Just hit his biggest win yet. About to be flush with cash, feeling like $1 million. But every single time he needs money for that next deal, he panics. He calls me in a cold sweat. And I can't find the money. I'm gonna lose the deal. And I told him the same thing that I'm about to tell you. Right now, while you're flush, while the bank loves the look of you, go get every line of credit you can. Not to spend, just to have. Same idea as that ladder. There's an old line about bankers. They'll hand you an umbrella the second the sun comes out, and they want it back the minute it starts to rain. The time to grab the umbrella is when you don't need it. Because the day you do, the day your values dipped and your cushion's thin, that's the exact day they quit handing them out. If you don't have a line yet, that's the whole point. Go get one or two or more and do it now while you still qualify, because the day your value drops is the day they stop approving them. I mean, I did it myself recently. I'm sitting on almost $100,000 in various credit lines I have zero intention of touching. Go get them while the getting is good. That's the move. That's the whole move. I mean, here's how I see it. The way our financial system works, and as government policies evolve, to properly defend your home, you have to run your house like a business. You got to run your life that way. And businesses need liquidity. And just because you are liquid doesn't mean you have to spend it. And look, I'm not your CPA, you know that, so do your homework. A credit line you never draw on costs you nothing, and it might be the only umbrella you've got when it starts to pour. So here's where you stand. 2 plays. Play number 1, you treat the house like the safety net it used to be, you wait, and you hope the umbrella is still there when it starts to rain. Or play 2, you go get that umbrella now, while it's sunny and they're still handing them out. Go get a credit line, an equity line, a credit card or two, access you don't even use. So the day your cushion thins, you're the one holding the keys. I mean, if nothing else, and very much before anything else, pull up Zillow or your county's website, write down what your house is worth right now. Divide what you still owe by that number. That's your loan to value. Under 80%, you've got some room. Over 80, or you're in Florida, Texas, Colorado, Arizona, California, where prices are already sliding, you're in the zone where the bank starts paying attention. Then open your mortgage docs and find the paragraph about suspending your credit line. Read it before they ever get to use it. Better to know now should home prices really start to fall. Now, if you're of the mindset that all credit is bad, and if it starts to really rain and things get really tough, you'll just sell. You're going to take your equity, you're going to take the win and just move somewhere that finally makes sense for the money. That's the escape hatch you got? I get it. That's the one move nobody can freeze. Except that's the exact part I couldn't stop pulling on, because there's a cut right now, sitting right at the closing table, waiting for the day you do try to leave. They're dressing it up as a millionaire's tax in some places, a billionaire's act in others, and it's quietly sliding into a dozen states' budget bills where you never get to even vote on it, pointed square at the homeowner who just wants to sell and go. And you don't have to be a millionaire for it to touch you. Don't let the labels fool you. And that's why I pulled this one out here for you to watch next. I break down exactly how that exit toll works, and the one question to ask yourself before you ever put that sign in the yard. Watch this one next. God loves you, and so do I. Take care.